Welcome back to the deep dive, everybody. We've been getting a ton of requests lately to do a show on wealth building, and honestly, it's been kind of surprising, like the sheer volume of material you all have sent in.
Yeah, no kidding. I've been combing through it all, and it's been pretty eye-opening, honestly.
What really stands out for me, though, is this theme of simplicity. We always think, or at least I do, that getting ahead financially requires some super complex strategy or, secret knowledge that only the Wall Street bigwigs have.
Right, exactly.
But a lot of what you folks have sent in, especially the summary of The Simple Path to Wealth by J.L. Collins, suggests something pretty different. Like maybe the most effective path is actually, well, simple.
Yeah, that's a really interesting point. I mean, we tend to think that huge, complicated problems need these equally huge and complicated solutions. And finance definitely has this aura of, like, complexity, right?
For sure.
But what's so cool about Collins' book and what this summary really highlights is the idea that the best strategies are often the most straightforward, the ones you can actually stick with.
Absolutely. And it's not like he's writing for financial experts, right? This whole thing started as a series of letters to his daughter, trying to teach her about money in a way that she could actually understand and use.
Yeah, and that really resonates with me. It tells you that this isn't about some fancy jargon or trying to become a day trader. It's about getting back to basics, like solid principles that anyone can grasp and actually put into practice.
Totally. So for our deep dive today, we want to break down those core principles, the stuff that you can use right now to start getting your finances in order. We're all about simplicity here, folks, and thinking long term. No get-rich-quick schemes, just tried and true wisdom that actually works.
You got it.
So to kick things off, part one of the summary really focuses on laying the groundwork, getting the right mindset. And I think it's important to point out that Collins isn't saying money is everything, right? It's more about what money allows you to do.
100%. Right off the bat, he makes it clear that money's a tool. It's about freedom and security. It's about having choices and not feeling trapped by your financial situation.
And he's pretty clear about what he sees as the biggest obstacle to that freedom: debt.
Oh yeah, he does not mince words there. Debt is the enemy, he says. And he's talking specifically about consumer debt, like credit card debt and car loans.
That's a pretty strong statement. Why is he so against this kind of debt?
Well, it's not just about the interest you pay, though that can be a huge burden on its own. The real issue is that it puts you in a constant state of playing catch-up. You're essentially paying for stuff you already bought, and those monthly payments just drag you down.
Makes sense. You're starting every month in the hole, basically.
Exactly. And with those high interest rates on credit cards, it's like you're running a marathon with ankle weights on. You're never going to get ahead. So his advice, which is more like a non-negotiable rule, is to pay off that high-interest debt ASAP. Like, make it your top priority.
Makes sense. Get rid of the anchors before you try to sail anywhere. So once you've tackled the debt monster, then it's time to focus on saving, right? The summary really emphasizes the importance of the savings rate.
Right on. This is where you shift gear from playing defense to actually building wealth. Your savings rate, which is the percentage of your income that you're putting aside, is like the secret sauce.
Okay, but isn't saving kind of a no-brainer? Like everyone knows you should save money.
Sure, but it's about being intentional and consistent. And the higher your savings rate, the faster you're going to reach your financial goals. It's really that simple. The more you save, the more you have to invest, and the faster that money can grow.
And that brings us to financial independence, or FI, as the cool kids call it. It's a term we hear all the time, but Collins gives us a really concrete way to think about it with the 4% rule. Can you break that down for us?
Okay, so the 4% rule is a guideline to help you figure out how big your nest egg needs to be to support your lifestyle without relying on a job.
So you're basically living off the interest.
Sort of. The idea is that if you have, say, $1 million invested and you withdraw 4% of that every year, which is $40,000, you can theoretically maintain that lifestyle indefinitely.
Interesting. So that $1,000,000 becomes like your own personal ATM.
Exactly. But it's important to remember that the 4% rule is based on historical market data and some assumptions about inflation, so it's not foolproof. But it's a great starting point for thinking about how much you need to save to achieve FI.
Okay, that's a great goal to shoot for, but it sounds like to get there, we need to really change how we think about money. Collins talks about a mindset shift. What does he mean by that?
So we live in a culture that constantly pushes us to spend, 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 right? We're bombarded with ads telling us we need the latest gadget or the fanciest clothes to be happy.
Oh, tell me about it. My Instagram feed is a nightmare.
Right, and Collins is saying we need to break free from that mentality. It's not about keeping up with the Joneses. It's about making conscious choices about how you spend your money, and being intentional about your financial goals.
It's about aligning your spending with your values, right? Not just mindlessly buying stuff because it's on sale or because everyone else has it.
Totally. It's about realizing that every dollar you save is a dollar you can invest in your future.
Makes sense. So we've laid the groundwork. Ditch the debt, save like a fiend, aim for financial independence, and most importantly, change your relationship with money. Now let's get into the nitty-gritty, the investment strategy itself. And honestly, it's so simple, it's almost shocking.
I know, right? It basically boils down to spend less than you earn, invest the surplus, and avoid debt. Like, that's it.
It sounds almost too good to be true, but that simplicity is actually the point, right? Because complex systems are hard to maintain.
Absolutely. And where people get tripped up is the investing part. But Collins has a very straightforward approach, and it all starts with understanding the power of the stock market.
Okay, but the stock market can be intimidating. It seems risky and unpredictable. Why is he such a big fan of it?
Because historically, over the long term, it's been the best way to grow your wealth. Think about it. When you invest in the stock market, you're buying a piece of businesses, and businesses drive the economy.
So you're basically betting on human ingenuity and innovation.
Exactly. And over time, that bet has paid off pretty handsomely. Collins points to the average annual return of about 7% after inflation, and that's pretty consistent across decades.
Wow, that's not bad at all. But the key, as the summary emphasizes, isn't to try and pick individual stocks, right? It's about diversification through index funds. So what exactly are those?
Think of an index fund as like a basket of stocks. Instead of trying to guess which individual company is going to be the next Amazon, you're investing in a broad swath of the market.
So like spreading your eggs across multiple baskets.
Exactly. And that's what diversification is all about. It reduces your risk because even if some companies do poorly, others will do well, and it all balances out.
So you're not putting all your eggs in one basket. Makes sense. But how do you choose an index fund?
Well, Collins recommends sticking with broad market index funds that track major indexes like the S&P 500. These funds are basically designed to mirror the performance of the overall market, and they're really low cost.
Low cost is key, right? Because fees can eat into your returns.
Huge. And one of Collins' favorite index funds is the Vanguard Total Stock Market Index Fund, or VTSAX. It's super diversified, covers pretty much the entire U.S. stock market, and has a really low expense ratio, like 0.04%. That means for every $10,000 you invest, you're only paying $4 in fees per year.
That's pretty amazing. So stocks are the workhorse of the portfolio, right? But Collins also talks about bonds. What role do they play?
Yeah, so bonds are like the steady eddy of the investment world. They're less volatile than stocks, meaning their value doesn't fluctuate as wildly.
So they provide some stability, especially as you get closer to retirement.
Exactly. And a good bond fund to consider is the Vanguard Total Bond Market Index Fund, or VBTLX. It covers a wide range of U.S. bonds, so you're getting that nice diversification again.
So with these two basic building blocks, stocks and bonds, Collins proposes a super simple two-fund portfolio. Tell us more about that.
Okay, so imagine you have a pie chart representing your investments. One slice is for stocks, represented by VTSAX, and the other slice is for bonds, represented by VBTLX.
Okay, I'm visualizing it. So how much of the pie goes to each?
That depends on your age and your risk tolerance. The general rule of thumb is that when you're younger, you can afford to take more risk, so you might have, say, 80% in stocks and 20% in bonds.
Okay, so as you get older, you shift more towards bonds for that stability factor.
Right. And the beauty of this approach is that it's incredibly easy to manage. You don't need to be constantly tweaking your portfolio or chasing the latest hot stock. Just set it and forget it.
That sounds incredibly freeing. So we have our investment vehicles, our two-fund portfolio, but just having the right tools isn't enough, right? Collins also lays out some crucial rules of the game for long-term success.
Oh yeah, these are golden rules. And the first one is invest early and often. You've probably heard this before, but the summary really drives home the point with that example of investing $10,000 at age 25 versus age 45.
Oh yeah, the difference in growth by age 65 was crazy.
It really highlights the power of compound interest. The earlier you start, the more time your money has to grow exponentially. And even if you can only invest small amounts at first, the consistency really adds up.
The snowball effect, right? Starts small, but it just keeps getting bigger.
Exactly. And the next rule is ignore the noise. This one is so hard for people, especially with the 2047 news cycle and social media constantly bombarding us with financial information.
Oh, I know. It's like information overload. It's easy to get caught up in the hype or panic when the market takes a dip.
Right. And Collins is basically saying, tune it out. Don't try to time the market. Don't listen to those so-called experts who claim to know what's going to happen next. Just stick to your plan and ride out the ups and downs.
Easier said than done, but I get it. Long-term thinking, not short-term reactions. And the final rule in this section is keep costs low, which ties back to what we were saying earlier about those expense ratios, right?
Yeah, those tiny percentages might not seem like a big deal, but over decades, they can make a huge difference in your overall returns. It's like death by a thousand cuts.
So choose low-cost index funds like VTSAX and VTLX, and you're good to go.
You got it. Now, the last part of the summary focuses on avoiding common pitfalls, and these are mistakes that even experienced investors can make.
Let's hear it. What are the traps we need to watch out for?
Okay, number one is market timing. This is the idea that you can predict when the market is going to go up or down and buy or sell accordingly.
Sounds tempting, but also impossible.
Pretty much. Even professional investors struggle to do this consistently. So the best approach is to just stay invested and ride out the waves.
Don't try to be a hero, just stay the course. What's the next pitfall?
Stock picking. We all dream of finding the next Apple or Tesla, but the reality is that picking individual stocks is incredibly risky,
Yeah, it's like trying to hit the lottery.
and the odds are definitely not in your favor. You're much better off sticking with diversified index funds.
Okay, so no gambling in the stock market. What else should we avoid?
Financial advisors can actually be a pitfall, or at least some of them can.
Really? That's surprising.
Yeah, the issue is that some advisors might be more interested in selling you high-fee products that benefit them than actually helping you reach your financial goals.
So how do you know if you can trust an advisor?
Collins suggests either managing your investments yourself, which is totally doable with his simple approach, or if you do need help, look for a fee-only advisor who acts as a fiduciary.
A fiduciary, meaning they're legally obligated to put your interests first.
Exactly. And the last pitfall to watch out for is lifestyle inflation. This is a sneaky one because it happens gradually.
It's like the more money you make, the more you tend to spend.
Right, you get a raise, so you buy a nicer car or a bigger house. But if your spending keeps pace with your income, you're never going to build wealth.
So the key is to keep your living expenses relatively stable, even as your income grows.
Exactly. That way you can keep shoveling more money into your investments and accelerate your progress towards financial independence.
Okay, so to sum it all up, the message here is clear. Simplicity and discipline are the keys to building wealth. It's not about finding some magic formula or getting rich quickly. It's about making smart choices and sticking with them over the long haul.
Absolutely. The summary really reinforces that achieving wealth through this simple path is totally achievable for anyone, regardless of their income or background. It's about understanding the basic principles and then having the discipline to follow through.
And the power of time is on your side. Compound interest is like that secret weapon that keeps working for you even while you sleep.
You got it. And for those of you who joined us today looking for clarity and a path forward, I think this simple path really delivers. It cuts through the noise and gives you a framework that you can actually implement and maintain.
So as we wrap up, here's a question for you to ponder. What's one area in your financial life where you might be overcomplicating things? Could simplifying your approach, like Paulins suggests, lead to greater peace of mind and faster progress towards your goals? And maybe, just maybe, figuring out your own personal financial freedom number based on that 4% rule could be the next exciting step in your journey. Thanks for diving deep with us, folks.